When you're looking up stocks online, you're generally inundated with way too much information, and it can be quite hard to understand, especially for beginners. When I was first getting into investing, I had quite some difficulty learning what all this information meant. And now I'm making this video to help people that are in the same situation that I was once in. When it comes to evaluating stocks, there is a 6-step checklist that I like to go through with every stock before I even think about investing money into it. When you're a beginner, I think it's really important that you go through this checklist because it's going to give you the highest likelihood of choosing a stock that returns you money in the long run. As long-term investors, we want to be investing in companies with proven track records so that we don't end up losing all our money. And I've devised this 6-step plan to help you pick the right stocks. And they're as follows. The first step is you want to stick to businesses that you know and use on a regular basis, especially when you're first starting out. As Warren Buffett said, never invest in a business that you don't understand. In a world with thousands of stocks to choose from, you're more likely going to be interested in a stock that you intimately understand. An example that I like to think about is Apple. Almost everyone has at least one Apple device in their home. So if you choose to invest in Apple, you're more likely to research the company because you understand it at the very least a little bit. And the second step is, once you've selected a company, you want to make sure that the economics of that company are solid. Buffett's favourite example to ask people is how would you go about buying a farm? And you'll probably look at how many acres the farm is, what kind of crops you can grow on it, what the expected revenue per acre of production is, you're going to look into the cost of running the farm, and what the resulting stream of free cash flow to you is. When you're buying a farm, you're buying a piece of that business, and that's what really matters when investing in stocks. You want to buy solid companies that have good business models. Investing isn't that complicated. We want to buy businesses that are financially sound and play the long game, but how do we do that? This brings us to the third step, which is financial statements. We can actually look at how a company is doing financially based on the holy trinity of accounting statements, which are the balance sheet, the income statement, and the cash flow statement. By knowing some key metrics of these three statements, you're going to get a full picture of what the company looks like financially. This is called doing fundamental analysis on a company, which is when you look at the company's financials, perhaps their management team, and the economic outlook. We're not going to look into technical analysis in this video, but quickly, it's just another stock valuation method generally used by short-term traders. If you would like me to make a video on technical analysis, let me know down in the comments below. But moving on. I'm going to give you a simple framework to analyze a company's financial statements, and you can find these statements for US stocks by going to sec.gov and using their Edgar search feature, then looking for their annual reports or their quarterly reports. But that can be a little bit complicated and not so friendly for the beginner investor, so I would actually recommend using Yahoo Finance instead. Yahoo Finance makes it really easy. For example, we can look at a company like Apple and then go to financials, and from there we can see their financial statement, cash flow statement, and balance sheet pretty easily. The first statement we're going to look at is the balance sheet, which reports on the company's assets and liabilities. There are two main questions that you want to ask yourself when analysing a balance sheet, and they are, what is the company's cash position and what is the company's liquidity? To figure out a company's cash position, head to the current assets section of the balance sheet and click on cash and cash equivalents. As you can see here, Tesla has about $22.1 million of cash. Next, you're going to want to find their debt. So if you click on total liabilities, then click on the drop down for current liabilities, you'll find the current debt that they have, which is only about $1.5 million. You'll also see under long-term debt, which is under non-current liabilities, that they have $1.5 million in long-term debt. Since Tesla has $22.1 million in cash, but only $1.5 million in current debt, that means they have enough cash to cover their debt for the next 12 months. Their long-term debt also doesn't seem to be an issue. They have more than enough assets to offset their long-term liabilities. In terms of number 2, their liquidity, we're going to want to find the current ratio, which is total current assets divided by total current liabilities. What we want to see here is a ratio above 1. That means for every dollar that the company owes in the short term, they at least have $1 of current assets to pay for it. So in the case of Tesla, it's actually 1.53, which is a really good sign. Now for the income statement. We look at the income statement to figure out how the company did in the previous quarter, and also the trailing 12 months. This is the document that's going to tell you how much the company made in total revenue. In the quarter ending 30th of the 3rd, you'll see that Tesla made about $23.3 million in revenue, and after all the costs, their net income was $2.5 million. This shows you that their net profit margin is around 10%. All you have to do is take $2.5 million and divide it by $23 million. A net profit of over 20% is generally considered pretty good, and anything over 10% is still considered okay. What you'll notice is that with healthy, stable companies like Tesla, they're going to have a net profit margin of around 10 to 20%, or even more. But there are some newer companies out there, for example Lucid Motors, the EV company, that has no profit whatsoever, and might actually be losing money. In those cases, the company is going to be a lot harder to value and a lot harder to figure out how their financials are doing. And you might be thinking to yourself, why would someone invest in a company that's actively losing money? Well, I'll tell you why. It's because many investors are speculating that growth companies that are losing money right now might turn profitable in the future, and when they do, it'll yield a way higher return. A famous example of a company that lost money for a very long time is, believe it or not, Amazon. In 1999, they had revenues of $1.6 billion, but they still managed to lose $790 million that year. They were also mocked a lot in the media. Famously, there's an article from NASDAQ in 2003 which is titled, "Will Amazon Ever Make Money?" So, while you can invest in growth stocks that aren't profitable just yet, those are going to be more speculative and not every one of them is going to turn out like Amazon. When choosing stocks as a beginner, it's going to be tempting to choose some of these stocks, but if you want a more stable and less bumpy ride, you're going to want to stick to the more stable and profitable companies. The last statement we're going to look at is the cash flow statement. This statement details how much money is coming into the company versus how much money is flowing out of the company. Ideally, you want the free cash flow to be growing year over year, and in the case of Tesla, this seems to be true. However, not all companies are going to be growing their cash flow this consistently over time. Free cash flow is a pretty good metric for showing the overall potential of a company, and it has three main use cases. The first can be used to pay down debt, because the more cash flow that is generated, the more debt that can be paid off. The second is for dividends, and the third is for share buybacks. Strong free cash flows are a good sign of the company's long-term prospects and actually might have shown you that the company has been outperforming the market over time. Alright, so number 4, the price to earnings ratio. And in the event that it's not available, you can look into the price to sales ratio. The price to earnings ratio is a metric that many investors will use to gauge the current valuation of a stock, and it's represented as the current price of the share divided by the earnings per share. You can also just look up the PE ratio in a stock screener like TradingView or even Yahoo Finance, but basically it's telling you how much you're paying for a given company's earnings. For example, if a company's PE ratio is 20, that means that investors are paying $20 for every $1 of that company's earnings. In general, a high PE ratio suggests that investors are pricing a lot of growth in the future, whereas a low PE ratio can suggest that the company might be undervalued. But the real way to tell if the PE ratio is good or not, or whether you should invest in the company based on the PE ratio, is to compare that company's PE ratio against all the other companies in that industry. Now, it's really important that you compare the PE ratios of companies in the same industry so that your findings are not skewed. If a company isn't profitable, then what you're going to have to use instead is the price to sales ratio. And what you'll notice is that many growth companies will use the price to sales ratio as a benchmark. This is really quite similar to a PE ratio, but basically it's the current price of a company's share divided by the company's sales per share. So, if the price to sales ratio is lower than a company that is actually profitable in the same industry, that might be an attractive investment, so people might buy it thinking it's undervalued compared to the companies that are profitable. Now, obviously all these metrics need to be taken with context, so don't just use one metric in isolation because that might get you in some deep trouble. Now on to number 5, which is looking at the company's management team as well as their leadership. You can find out a lot about the management by reading the transcript of a company's earnings call and annual reports, and you can also research a company's board of directors, check out the executive's LinkedIn profiles, and even how long the CEO of the company has been working there. Generally, if a CEO has been at a company for a long time, it's a pretty good indicator because they know the ins and the outs of the business. Most notably, when you have a really key executive leave or a key executive join, you can see the stock price is reflected in that because of people's expectations for the future. And finally, the 6th and last thing that we want to look at is competitive advantage. We want to ask ourselves, does the company have a competitive advantage? Having a competitive advantage will give the stock you're investing in the best possible chance of succeeding in the industry that they're in. For example, AbbVie, which is a pharmaceutical company, owns the exclusive rights to Humira, which is one of America's most popular drugs. Their competitive advantage is the fact that they own many patents to exclusive drugs in the pharmaceutical industry, so competitors can't just come up and take their market share. Other competitive advantages for companies could be, for example, brand. Like Coca-Cola has a huge competitive advantage just because of their branding alone. Or you could also have things like their business model or their ability to innovate. And someone that comes to mind when I'm thinking about innovation is Elon Musk, who's the head of Tesla. Now, if you're a beginner investor, one of the best things that you can do for your own portfolio is diversify your investments across many different stocks. Because the last thing that you want to do is go all in on one stock, then that stock goes bankrupt and you lose all your money. I hope that this video helped you gain some viable insight on how to invest in stocks. We want to be looking into a company's full financial picture and investing in good companies. If this video provided you value, please like and subscribe.